Okay. So as we begin the first course, I just want to give a little bit of an introduction. In general, the style is going to be more ad lib. I'm winging it. I'm pretty much as a baseline. We're going to use the report that was printed out and given out to you. And as a second, I'll try to also go off tangent a little bit and give live stories and examples so that it can relate to each of you as you're taking the course. For those that are watching the video, I'm sitting in a room here with almost 20 people. And like I told them before, that I guess I'm gauging the reaction that I see on the facial expressions in the room. I'm assuming indicative of everyone else that's out there. So also, if you see my eyes moving left to right, it's because there are people there. As an introduction to the course in general, I want to say two things. I went to a real estate course several times. And one of them I went to was by David Lichtenstein. David Lichtenstein is from the largest real estate owners. He bought the largest project years ago before the last crash. And one thing which he said about why he liked real estate, and he went into it, is that real estate is a very low barrier to entry. You don't need a college degree. You don't need any special expertise to go into real estate. It's all logic-based. You could visualize your own house. If you lived in your first apartment, you paid rent, and someone came to collect your rent, and if you had a problem, you called them problems. So instead of one apartment or one house, it's a 2-family, a 4-family, an 8-family, a 100-family, just multiplying that by size. But the whole real estate business is a logic-based business. That's the whole business. And because of that, as long as you are able to figure out how to raise the money, build connections and relationships, there's no one's going to tell you, I'm sorry, even though you want to do it. Like someone could think they're a great doctor. They could have watched someone perform many surgeries, and they could wake up in the morning and say, I want to become a doctor. It doesn't work that way. You think you'd be a great lawyer naturally, it doesn't work like that. There's a barrier to entry. You have to go to school, you have to get a degree. There's a lot of things before you could do it. When it comes to real estate, you don't have those barriers to entry. It's good and it's bad, but you don't have, there's none of those barriers to entry. The second thing is, in general, I want to give a general look at real estate. There's always going to be a question, like, if the deal's so good, why is the guy selling? Always has those questions that always come up as a natural question. So I'll relate to the question with feedback we get when we give courses like this. We offer a course like this. There's 3 reactions. There must be a catch. Why is he giving a course? And because you can't figure out the catch, some people just don't take the course. I just can't figure it out. I'm not taking it. That's one reaction. Other people say, I couldn't really care what the catch is. Does it help me? Does it hit my goals I want to accomplish in life? I'm going to take the course. I don't really care. And other people say, yeah, I know his goal. The goal is to give a course. And you could think of whatever reason you want to think, from altruistic to selfish. But the bottom line is, at the end of the day, you could figure out how your motives are aligned exactly. You understand this first and you go into it. The last way is the best way. The last way is at least try to come with an understanding of why it works for you. Why do you think the other person's selling it? Why it works for you. So at least when you're going into something, you're more knowledgeable about it. The people that don't make it in life are the people that take the first approach. Just can't figure it out, so they stay cold and they walk away. The middle ground also works many times. If there's a deal, it makes sense. You don't understand why I'm not selling it, but you have to be skeptical about it. You know, they say the story that this person was traveling, and he lives in New York, and he was in Chicago, and I think that's what the story goes. And he came into Chicago, and he saw that a great building for sale. Let's say a building, normally trades at we'll go into the thing later on, normally trades in that market as a 6 cap. And the higher the cap rate means that the value of the building is less. So it's trading out as an 8 cap. So I'm saying such a great deal. The building should really trade for $10 million. I'm able to buy it for $8 million. It's a great deal. It's about to buy it, and I said, raising money for it, it's a great deal. And he calls up a friend of his, he goes, that's the truth, I should take an investor in Chicago. He calls up a friend of his, tells him, you want to invest in this deal with me? He goes, are you crazy? Don't you know they're moving the airport? All the traffic this building generates is because the airport's right next door. They're relocating the airport. So sometimes you want to know why someone's selling it. And if you understand it, you can still make it work because you could be creative. You could be creative with it. Could you build a new floor? Could you change around an apartment? Could you do different things? And that's the creativity that comes with it. But the mindset is definitely a mindset when you're looking to buy real estate, be a level of detective. Come into it and ask questions. And ask questions about why. Question everything. As much as you can, get the answers, then apply it to yourself. Does it still fit into your box? I say in life, in this real estate course, in life, everybody has an ulterior motive. Everyone you do business with, everyone you come in contact with has an ulterior motive. The key is to surround yourself by people with their ulterior motives match up to your ulterior motives. So at the end of the day, take a best case of a salesman working in a company. The boss wants to make commission, and the salesman wants to make commission. The motives are aligned. The sale should take place. They both benefit from it. Doesn't mean it's a bad relation because someone has an ulterior motive. Even if someone does have an ulterior motive, you want to go ahead and be able to figure out how to work from there. As I'm starting to go through on section 1, page 2, is the disclaimer. I'm not reading it verbatim, but this is the key thing. I'm talking to you as a layman. Don't look at it and say, oh, that's a company, it's doing this amount of business a year, so I took his advice. I'm not giving any advice. Nothing here is construed as advice, and everything should go from accounting and taxes. I'm not a lawyer. I'm not a lawyer. I'm not an accountant. I don't have securities law. I have nothing. I'm just telling you as a layman. There's someone sitting on a train next to you one day. They ask them, what do you think? I'm answering as to what do I think. I'm not saying anything more than that, and it's enough intel to give it to you that you can walk out of here and really be able to practical examples to it. The reason why I felt, so going to the next page, is I felt that, I have a broader handle of real estate. It is not so much because of my knowledge base. I have this genius knowledge about real estate. That the part of the business that I focus on is finance. And finance, by dealing with the banks, in order for a bank to lend money, they have to be very secure. In order for them to be secure, they are forced to check every single aspect of the business. If I'm buying and selling a piece of real estate, the only thing I have to care about is if it makes sense to the buyer, the price. That's it. I don't care why, what, where, and when. A lender cares about everything. If I'm leasing apartments, I just care about this apartment looks nice. I lease out the apartment. I don't care about everything else in the building. I don't care if the owner's in trouble, not in trouble. It doesn't make a difference. This unit, I rent it out. But don't lend money on the building. To be involved in the financing, they get involved in every single step of the process. They drill down to every part of the process. And because of that, I'm forced in the business that I'm in to deal with every single segment of the real estate business. I happen to think it's the best business to be in. Market's changing, but the best business to be in, beside the real estate business, is because if you line up the most successful finance brokers, most successful real estate brokers, in every segment of real estate, you line up the top five group to group are on the finance side of the business. And the main reason is, and parts of these fundamentals, the pricing, it might be changing over time, but the main reason is that unlike your home that you have, where you take out a mortgage, the only time you're going to refinance that mortgage on the home is in one of two scenarios. A, you need money for something. B, the rates drop. It's the only way you're going to refinance. When it comes to a commercial piece of real estate, even a commercial, when I talk commercial, I mean apartment buildings also. I say the word commercial, it's multifamily and commercial. A commercial piece of real estate takes out, they don't get loans for 30 years fixed. They get loans like equivalent to like a 5-year adjustable, 7-year adjustable, 10-year adjustable. So when you drive up and down any street in your city, main on main, those streets, every single building there almost every building has a mortgage, and almost every single mortgage has to be refinanced within 5, 7, or 10 years. So if you do a loan for someone today, you get his other loan. In addition to that, how many people do you know that own just one building? Most people in real estate, they buy one, a couple years later they buy a second, so on and so forth. So once you break into somebody, you have recurring business, not recurring in the true sense of recurring, but you can break in and tip his partners, so on and so forth from there. And that's where you come out. You sell a building once. You do maybe a couple transactions a year, that's how you make your money. In finance, you can do multiple times of that. So I want to go back from the beginning. Page 3. Why do you invest your money? Someone sits on money in the bank. If someone sits on money, why do they invest it? Why don't they keep it in the house? Let's start from ground zero. The reason why they invest money, the main reason is to protect your money from inflation. That's the main reason. And the simple definition of inflation to understand it is today, if you wanted to buy a pizza, a pie of pizza costs $10, and I buy pizza every week, so I have $520 in order to buy pizza, $10, one pie a week. If next year the price of pizza goes up, inflation means the cost of goods that you spend money on goes up. Now pie of pizza costs $11. All you make is $500. You allocate $520 to buy pizza next year. You'll not be able to buy a pie of pizza for the whole next year. You're gonna have to eat less if you're only making the same money, or you only have the same money. So protect against inflation. If you put that money in the bank, and the bank is paying you an interest rate equivalent to inflation, using this example, it's not that crazy, but using this example where your life is revolves around pizza, and it's $10 a pie goes to 11. If you don't get 10% on your money, when you put $10 in the bank, you're not going to earn 10% on your money to give you $11. You get $1 more. 10 plus 1 is 11. Then in a year from now, you have a problem with inflation. So your goal is a minimum to maintain against inflation. So when they talk about retention of money, People that are very wealthy, that's the focus. The focus is that the money should be worth at a minimum what it's worth now. That's the basic level investment. The safest investment, perceived safest investment, is putting money in the bank. Lending money to the U.S. government in Treasury bills. That's perceived to be the safest investment. But if you look at the returns there, they're not pacing inflation. Banks will be paying you 1% or less, and they talk about inflation being 2 to 3%. They also play with the inflation numbers. They don't play with your deposit money in the bank. You put money in the bank, they don't play with it. They tell you we're paying you 1%, 0.5%. Inflation, when they give a number that inflation is only 2%, because they don't include the cost of your cell phone bills going up. Well, now cell phone bills going down. But they don't include some items. If you look at the inflation report, excluding, they give a whole list of things they exclude. Your cost of living went up way more than just 2 or 3%. If you didn't buy anything new, the same items last year that you bought went up this year. So that's the number one reason. The second thing is return on investment. So the joke, the play on the words, the acronym is ROI. And the ROI stands for return on investment. The joke or the reality is really it's the return of investment. So the difference of the most safest investors in the world, they focus first on, I'm investing $1 million. Show me that I'm protected, that I will not lose my investment. I invest $1 million, I want to make sure I'm getting back my $1 million. That's first and foremost. The mistake that most people make is I tell people they go into real estate. I can't say most people that go into real estate, but I say a high percent of people who go into real estate typically did not go to college and school. They're owners. They typically are bought their first building. Most of them, you date back, I can't tell if it's second generation, but if you date back to where the family business started from, it started from someone that worked as a laborer. They were the electrician in a building. They did construction. And one day they saw a deal. Someone came to, you know, to build, let's go partnership together. They didn't have a degree. They didn't have a college degree. They went to it. And one of the things you train in college is you train to focus on the risk. Risk versus reward. The word risk comes first. When you don't go to college, don't go to school, you take it the opposite way. It's reward versus risk. And those of you who watch Shark Tank, you understand that look at all how they drill down the investment. What's the most important thing they focus on? Is never the return. They focus on first retaining their money. Because we're sitting here talking about inflation. If I have $100, am I going to next year be able to buy the same amount of pizza? But go the other way around. If I lose my 100 to 90, 80, 70, 60, or 0, I have nothing left. So the first and most important thing is why do you do it? Is inflation. Then you want to move up from there. But in order to even begin, it's protecting your principles. The first thing you check when you do anything is protecting the principle. But the reason why, if you have the money to invest, or you want to do an ROI, you want to make an investment. You want to make an investment to be able to, just like you work, you come to work 9 to 5, you get a paycheck, and you were able to save your money and not spend every dollar in your paycheck. You put money in the bank. You want your money to work for you also. So you work, and you want your money to work. That's the general concept. Why should I have my money just sitting there if my money could work for me? So let me take my money and find a safe investment. But not only will I just protect myself on the investment, the core, the principle, I could protect myself against inflation, and on top of that, make a few dollars off. So when I have my $100 in the bank or invest it, not only am I going to get my few percent more than I need for inflation, I'll have extra money sitting in the bank and keep growing my portfolio. Whether the reason why you want to do it is for retirement, all those are separate reasons to what level of risk you're willing to take. So when you go to a financial planner asks you, what are you doing with your money? And that's another point I want to say. You're going into the real estate and the finance and on the side. We end up dealing with the richest people. I went to someone from the number one most successful brokers when I started in the business, and he told me what he loves about this business is he loves that he's able to help people make a lot of money and experience the richest that are rich. So, when they want to talk about, you want to find out about financial planning, who you calling, who's taking your phone call. But you call any one of your clients, and who do you talk to? And you make that phone call, he's answering all the questions that you need to get answered. Sometimes they have in-house people. So when you talk about the financial planning, they are telling you that 30 years out, if you're looking for retirement and you're not looking to touch the money for 30 years, you can take one level of investment. You don't care about the dips up and down. You look at a horizon over 30 years. How long is your horizon? Do you need an investment just for 1 year? You can't take such a big risk. You can't afford that this year you lose your money. If you're putting in money over 30 years, you can take different approaches. But what do you care for? You want that your money should earn you money. And that's the ROI, return on investment. The last part of it is, and this is why real estate has something to it, you also want, if possible, that the investment you make increases. So let's go, for example, you put $100 in the bank. That 100, that when you, at the end of the year, the only thing you're taking out of the bank is the 100, whatever percent they promise you. You put money into some investments. Not you buy yourself a stock that has dividends. So not only are you getting the interest rate and the dividends that you're getting back every year, but it's possible that $100, when you say I want to take it back, it's no longer 100, it's 110. It could be a risk going down to 90, but the investment itself could also go up. So that's the other part you want. The dream of every single investment is that your principal that you have is also growing, and the ROI, the return on it, the interest rate you're making every year, you're getting your money's getting a salary, so to speak, while it sits there. When you pull it out, you're able to pull out more in a sale. The complicated word, we're going to get to it later, is IRR, internal rate of return. Internal rate of return basically calculates for you. It says, you know something, I don't want to hear all these different levels of money. Bottom line is, if I invest $100 and I take out $10 this year, but when I sell my $100 investment, I get $120 for it. So I made $30, $20 profit, and $10 on my return. Put it all together. How much did I make? You made 30%. It was 1 year, your investment, you recouped 30%. If the same exact deal happened over 3 years, happened over 2 years, let's say, so you made $20 when you sold it, plus every year you made $10. You made a total of $40 over 2 years. That same investment returned to you 20% a year. Because if you look at an IRR, because there's two parts of it. It's how much did I sell my $100 my investment for? I bought a stock. I sold the stock. I bought it for $100. I bought it for $120. Assuming that took you 2 years before you sold it, you made $20. If it took you 1 year, you made the same, and the same 120 was over 1 year. So do you amortize? You divide over that $20 over 1 year or 2 years. So I made $10 a year, I made an interest. That's 10%. Plus, to either get, if I did it after 1 year, I made 10 plus 20, it's 30%. And the second year, if I divide over 2 years, then I made 20%. So sometimes some people sell their real estate. They're selling the real estate. You meet them and say, I don't understand why you're selling your real estate now. You're making 10% a year, 15% a year, 18% while you're selling it. Their answer is because there are different people that are able to go ahead and buy real estate and take different levels of risk. So for example, what's that level of risk? If I asked each of you, take a room of 100 people, and I tell you, the house right next door to you, where you live, you know your neighborhood, you know your house, you've been living there your whole life, you have an idea what your house is worth. Let's say you believe your house is worth $500,000. The identical building comes for sale next door. The neighbor's there, says, listen, he's getting old, he goes, I'm selling, I'm moving to Florida. I want to sell my house. You know, so I made a decision now, I'm leaving on Monday. If you give me the money by Friday, I'm willing to sell. How much you willing to sell for? $450,000. You know that the house is worth $500,000. You don't have to trust anybody. You know you live there your whole life, you're not in real estate, but you know the value of your house. Or $425,000. How many people in the 100 people in the room would actually go out there and say, no, something, it's 2 days left. I'm going to raise the money. It's a quick money. I'll raise $450,000. A few days later, sell it to someone else, and I'm out. I made $50,000, $75,000. Okay, so some expenses. Let's say you buy it for $400,000. How many people do it? The number out of a group of 100 is probably 15 people or 20 people. But seriously, think about it. How many actually execute? It's a different discussion. That's not for now. But the mind's only 20 people max. 20% will entertain it. Let's go back in next degree. The house is dilapidated. It needs $100,000 of work. But he's willing to sell it to you for $280,000. Let's put $100,000 of work into it. It's $380,000. Headache when you do construction. Maybe you might go overruns with the costs, but then you're going to make for $500,000. How many then will do it? Of those 20, it drops. 15, 10. I don't know the exact numbers, but it drops. Think about if the building was a piece of land. He's selling it at the cost to build the land and buy the land. You're in for $300,000. You make $200,000 profit. Even less with it. There's some people who only do it at the land stage. Say, if I'm already doing all this headache, I want to make big returns. I'll do what's called sweat equity. My equity won't be money. It's my sweat. I'm going to work hard for this project, and that's how I'm going to go ahead and make my money. There's different risk tolerance. The person that buys the piece of land, or better yet, the person that buys raw land, undeveloped, unzoned, raw, starts assembling land, that person doesn't take it to the end. That's their expertise after a while. They buy land, they put it together, and as soon as it gets to a point that the next person is willing to pay a premium because it's done already, whatever the next level of baking is, that's when they sell and they move on. Because in their world, they want to make, and you meet them, oh, I make 40% of real estate. Really? I never saw a deal throws up 40% today. Their 40% is because this is what they're buying. They're buying from point A to point B. If someone goes from point B to point C, very, very few people in the world go from zero to the end. You go there if that's not thinking finance and you have money and you're building in your neighborhood. But for most builders, they start at a certain point, end at a certain point. And that's where it goes from. So on page 4, section 1. Risk versus reward. Usually the higher the risk, the higher the return. And it's really recapping, as we're going to talk, it's some of the things that can go faster because different parts were said before. The low risk is depositing money into a bank if the bank is FDIC insured. The benefits are your money is collecting interest and you're liquid. This is the key thing. You put your money in the bank, you're liquid. Any moment, you call up the bank, you take your money out, you're getting your $100. You invest in stocks, it's also pretty liquid, but it's risky liquid. If you need the money on Tuesday, and that morning the stock market's down, your $100 is $93 or $98. At the bank, your $100 is always there. You're liquid. So that's why there's a lot of people. The lingo they use in the world is dry powder. Talk about something. How much money do you have to invest? How much dry powder do you have sitting around? That's like the lingo. The dry powder that they talk about is that sometimes people, you ask a person, I don't know why, I come to a guy with an investment and say, like, you're sitting with a couple of $1 million in the bank. Why don't you buy this deal or buy this investment? Invest here. You'll make whatever the return you're going to make. And the person's response to me is, I'd rather sit with the money in cash. Because there's some people sit with money until they get their investment. So look at the concept of IRR, the other way around. I want to make 15% of my money. Let's say that's my target. Right? You bring me an investment today for 10%. I'm not going to take that investment. I'm not making my 15. But you can tell me your money's sitting in the bank at 1. You're losing. I say, yeah, but I'll find an investment that's going to throw off 20%. And even though at 1 year at 1, 2 years at 20, or whatever that numbers average out to, I'll average my 15% that I'm looking for. So some people just take certain stances and they go that way on a scientific level. Other people, it's not scientific, just emotion. This is how I do things. So that's what I say about the course when you started the course. Some people make decisions totally emotional, some people totally logical, and it's financial decisions. And some people always, that's their business model. Leave a certain percent of their money available in cash. So therefore, they can make investments. Therefore, they're never stressed out. They get a great opportunity, they want to capitalize on it. So they have buckets. This money, I'm only doing it to make a crazy return. The rest of my money, I invest regularly. Why they do it that way, that's a risk tolerance you have. There's no right, wrong, or different. It's how your brain thinks and your risk tolerance. When you first start out, you have one level of risk. I met with a venture capital firm. And to understand who invests in companies as Uber, like an Uber, who invests in these types of startups that is either all or none. And I've been making money for years. And their answer is that in order to make these investments, you have to make 20 investments. That's the business plan. They know going into it that they're making 20 investments at the same time. Now, when I only have $5 million to invest, my 20 investments are $250 each. So whatever piece I get of it, $250 each. So I know 10 of them I'm going to lose all the money. 7 or 8 I might break even, but 1, 2, or 3 will become a home run. Now, is it possible I make that investment in all the bad ones? I get all the good ones? Obviously, everything is possible. But at the end of the day, you're playing a numbers game. The 20 deals you're going into. It's very simple. Some people are saying on $1 billion. So they could divide up over $1 million as an investment, or 10 million investment, or 50 million investment. And others are sitting on much less money. How much could you afford to lose? And that, how much can you afford to lose is going to make a difference. So, the example it's given is that when somebody goes gambling, how much money is the question that you have to lose before you have to tell your spouse? It's like the question. That's the risk tolerance that you have. This is the amount. This is the amount of money I can play with. After this, I got to tell my spouse. And I have no one to tell my spouse. Then my spouse will get all nervous. So therefore, I'm only playing this amount of money. I was once talking to a banker that worked at that time in Washington Beach, which is no more. And he was telling me some ideas I wanted to win the market over. He told me, you know that I could lose $60 million in the bank before we have to tell a shareholder. Like, that's how big the bank is. You know what I mean? Like, $60 million is a rounding error. So they could experiment on things below $60 million, they'll think about it. Above $60 million, they'll start thinking about it. So anything you have for me that's less than $60 million that I think is good, we're going to prove between the board here. Just using the concept. They're no longer here, but it says something to it. Actually, the person that told me was on the one side of the bank that made money, the multifamily lending. So, the whole bank overall took it from there. So, on section 1, page 5. So far, the course that was given up until now, and nothing to do with when you take this course. It's the same concepts that apply now and forever. It's like I tell people a lot of times, the key in life and business is to figure out what your strengths are and polish and work your strengths and neutralize and partner up with people for your weaknesses. Don't spend your day trying to fix your weaknesses. If you're great at something, you have a natural like for a certain thing, don't let someone tell you can't be successful because you can't ... You can go be successful in that area. The key though is know what your negative is and figure out a solution that someone else is covering you for that negative. So by myself, when I personally focus on the businesses, I focus on the business all the years that I'm in this business, on the parts of the business that never changes, the fundamental parts. So if you'd walk over to me today and say, I run this neighborhood, what are the cap rates? How much are rents for a 2-bedroom? I have no idea. How much are buildings trading? I have no idea. And I'm never going to waste my time spending my time to understand it because it's irrelevant to me. Because I'm surrounded by people that with a lifeline, one phone call away, or one click on an app that we have or on the internet, we get those answers. So there's some people they're great at numbers, and they're great at their memory works a different way, and their success in the business is being that expert to know neighborhoods. They know everything going on in the neighborhood. So they read papers, they read everything about a certain neighborhood. There's nothing about that neighborhood or that market they don't know. I partner myself up with those people. So when I walk into a meeting, I have that information down to the detail and the sales and fundamental part. That person's success is aligning themselves up with salespeople that need that information when they go present by a meeting. This is the first part of the business of the course that's actually is going to be changing every single day. I think at this point it's only changing upward, but the slightly higher, going back onto page 5, other low risk investments. The slightly higher, yet still low risk, is buying U.S. Treasury bills, which as of March 1st, 2017, yielded a return of 2.35%. So this is a number that keeps changing, and it's moving up, moving down, and the way this works is, as far as you're concerned as a layman, what the Treasury bill is, look at it as you're lending the U.S. government money. What interest rate is the U.S. government willing to pay you back? If you lend them money today, they're going to pay you at 2.35%. That's the paying you. When people are nervous about the stock market, again, they want to be safe and secure. They'd rather not make a risky 10% potential return. If you think the stock market's going to crash, someone takes all the cash out of the stock market. What do with it? They lend it to the government. The government has a lot of people who want to lend them money today. They don't have to promise 2.3%. They can promise 2.28, 2.25. Now, it's not really the government that's sitting there at a window and raising and lowering the pricing like a bank. What's really taking place is that I'm not going to go off tangent because it's not real estate, but the concept really is basically it's a stock with a dividend. The government, in effect, comes up with a bond. That's a bond deal. They basically decide tomorrow morning that they want to go ahead and they want to borrow $1 billion. So they float $1 billion bond. And they promise you that at the end of the 10 years, you will get back. I'm rounding these numbers out with inflation and everything. I'm simplify it, the simplest form of the concepts. Is that they will say at the end of the 10 years, this bond will give you $1.2 billion. Will give you, let's bring the numbers much smaller. We're doing per $100 instead of floating $100 bonds. And 2% is what they want to pay. They say after 10 years, you will get 20% after 10 years. So you get $120 after 10 years. How's it going to work? They're going to pay you a dividend. Every year, they're going to pay you 2% on the money. And then at the end of the 10 years, you will have your 20%. This is what happens. I go out there and I buy this bond. I give the U.S. government, again, this is not an actual how it works, but concept-wise, you can understand it. I go and give the U.S. government $100. They give me a bond. And every year, at the end of the year, I could cash that bond in. I could show them the bond, and they'll give me my 2%. At the end of the 10 years, when it matures, they go out there, and I give them the bond, and they'll give me back my $100. That's how the concept works. So, if everyone believes that the U.S. government is going to file for bankruptcy, and I have this bond for $100, then the problem I have with it is I'm going to still get my 2% as long as they didn't go bankrupt. I'll come at the end of the year, I'll get my 2%. But no one else is lending the government money at 2%. The government wants to borrow money. If you want to borrow money from me now, and the rumors you're going to go bankrupt, I'm only going to lend you money if I'm getting a 4% interest rate. In order for me holding the bond at $100 to get 4% interest rate on my money, I have to sell this. Someone else, if I want to get rid of it, I want to cash out my money. If I can't wait 10 years, I want to cash it out today. Someone will give me $50 for it. Because if they give me $50 for it, and I'm giving them $2 back, the only way they're getting the return that they're looking for is to get $2 on the $50 instead of $2 on the $100. So the bond goes, when people talk about junk bonds you hear on the news, is basically a simple thing. You could have your own view of retail. What's happening to Staples? Staples wants to borrow money tomorrow. They borrow money at 6%. If you think that Amazon is taking Staples out, they're not going to exist. Staples wants to borrow money tomorrow, they're not paying 6%. They're paying 12, 14, 18, 20 junk bond ratings. They're going to go out there tomorrow and start paying and have to pay those returns. The people who bought the bonds in the beginning, they want to sell it. It's not worth the same money. It's worth much less. Because in order to make that the return that you're getting is fixed, 2% a year in the beginning, you have to pay a much lower amount to get the return that you're looking for. So on the flip side, where the people make a lot of money, people felt, no, I think we're going to turn it around. Staples going to come back around. They're going to reinvent themselves. They're going to be the safest company anymore. People bought it the other way around. They made a lot of money in the bond market. They went out to the bond market and they bought they took over people's positions that lent money to Staples. Staples became a better situation, then they were able to sell it for more because people were willing to make less. So the world that, bring it back to here, is that as far as you're concerned in the world, you care about one thing. What is you look at the paper today, live, what are the bonds trading at? You don't care about how much people buy and sell the bond is, you care about the yield. You don't care if they're selling a bond at $100, selling it for $101, or selling it for $99 the bond. You care what is the percent return I'm going to make. That's all you care about, especially going to real estate. I go out and borrow money. I'm borrowing money. The bank says the cost of money is the Treasury bills plus. The starting point is Treasury bill. So if you're lending money simple in a simple form to get the concepts done, a bank is lending money at 1%. The U.S. government today will lend you money at 2.35. As people think that interest rates are going to start rising, then the U.S. government will pay you a higher rate. And that's what goes on. It goes back and forth from there. The higher risk, but still quite safe, are high-rated bonds. AAA bonds. What's a AAA? And they downgrade a lot of companies. What's the concept of the best rating is AAA. AAA rating is something like Apple. Apple will lend at 2.4%. So basically, if you're sitting on money today, I have $100. What can I do with my money? I can put it in the bank. It's liquid. It's never going to go up. The $100 not going to be worth more or less. It'll give me a 1% return. I could lend it to the U.S. government. I get 2.35. I can lend it to Apple at 2.4. Some people say for that difference, I'd rather be in the government. Some people say for that difference, I'd rather be lending to Apple. It's a preference. And you could keep going. You could lend it to an even weaker company, and your yield will be greater compensation for your risk. So you could decide which business you think is going to survive or not survive. And that's why if you look at privately held companies that borrow money, they're typically paying a low of 9% to 12, 14, 18%, because they don't have the broader market to invest in them. They don't have the kosher certificate of being a publicly traded company. There's all the checks and balances in there that the world can invest in. So when someone puts away money for retirement, where's the most money? In the retirement accounts that people put away. That money, or life insurance companies. I think those two combined, pensions and retirement, that's where the most money is to invest. There's a lot of restrictions where they can invest. They can't just lend to a private company. They have to lend to publicly traded companies that have ratings. So because of that, there's like a big divide. If you're publicly traded, or if you have a bond, if you have a rating, like a rating is like a credit score. You have a credit score, you're a 700 score, 600 score, and if you're rated by a bond rating, then to a certain level, they can invest with you. So since there's a limited number of companies and unlimited amount of money, that's why there's a big divide. And once you go out of that group, there's a much bigger return. That's why that people who specialize in lending to companies that are really healthy, they're fun. So take an example. You have a friend of yours in a low level. You have a friend of yours we'll use pizza, we go to the pizza shop example. He has a pizza shop. Everything is reported. Everything comes on credit card receipts, everything is into the register, everything's reported. He's actually making for the last 10 years $200,000 a year. He wants to borrow from you $100,000. Is that a safe investment, a safe loan? I think so. It's a safe loan. But no one else is lending him the money unless someone who knows him. Because who wants to deal with just a $100,000 loan? He's going to pay a high rate. That's what regular banks, lend to small businesses that have track records. What happens to the person only 2 years in business? he's in business 10 years, he'll find the bank to lend him that money and pay a very low rate, 5%. He's only 2 years in business. And a bank needs 3 years of history to show that it's safe. He can't borrow money. So even though it's a great business, he's making a lot of money, his only choice is to borrow from outside people. Junk bonds, publicly traded companies like Radio Shack. Radio Shack announces that they're having problems and people are going to go bankrupt. That means if you lend them money, it disappears. Who's lending the money to? Many times the people lend the money are people that know the story. They know and understand how much the assets are worth. So they know that if I could lend them money and I'm first position, even in a bankruptcy, I'm covered. Because even if they close down tomorrow and they sell everything, they're going to liquidate $1 billion. They have $5 billion in debt, let's say. But if I'm first position, then I'm fine. The problem is, in many cases, someone goes bankrupt, the $5 billion is even. So everyone gets 20 cents on the dollar. It's $5 billion in loans, $1 billion that comes in on the sale. So there's $5 billion that there's a 20%. That's why there's some people, their expertise is they lend money to companies that are in bankruptcy. Because when a company borrows money after they go into bankruptcy, as I understand it, you get first lien on the money. Because how can they survive? Basically, the court turns around and says, guys, listen here, $5 billion people. If you're not going to lend them money to keep their operations open, they're going to have to sell everything, liquidate tomorrow. They're only going to get $600 million for the liquidation tomorrow. If they have time to sell it, they'll get $1 billion over time. So someone wants to lend them $100 million, let that $100 million go first. But $100 million could be deemed the safest thing, even though they're lending to Radio Shack, if you believe Radio Shack is running into problems. That's where the up and down goes. Real estate doesn't get that complicated. There's not that big swings in real estate. You have a building, your rent moves up a few percent, some expenses. It's not a big swing as you go down the line. Bonds are considered less risk than bank deposits, but can be converted to cash rather quickly and easily. So if you look at page 6, it's just giving an illustration of what we're discussing. So you see the difference of the returns that you're able to get as you start buying different deals in different real estate. Real estate also has other tax advantages, has negatives, positives, but that's why real estate deals, you just have to work it. The reason the other 4 in blue, you don't have to do any work. You write a check and goodbye. You're buying a piece of real estate. The group is doing a lot of work in that transaction they're buying. Like, can you invest passively? Then again, you're not getting the same returns. You're getting, someone in the process taking some of your money away. But that's the general idea of why people invest their money. What's the starting point? Why they go into real estate? We'll get into it over the course of the course, but that's just to give you a level of background. There's another thing that someone pointed out to me also: invest in real estate, invest in a stock. You invest in Apple. You could think that Apple made the greatest move by getting rid of the headset, plug. You think it's the greatest move? They made the stupidest move. You have no say. You want to understand the financial statements? You can't understand it. You have no say in anything. You're just basically trusting that the market's going to like Apple and think it's a great company. Tomorrow morning, a few of their phones explode, or the iPhone 10 comes out and people just don't love it anymore. That's it. The price of the stock is going to drop drastically. Will they always sell hundreds of millions of phones? Yes. But they priced in the value of the company of Apple based on the fact that they'll always innovate, they'll always sell hundreds of millions and always grow. The minute they stop growing, then the bubble goes out. To what extent could you get stuck? So that some people say, a value stock, I'll wait out over time. With real estate also. Some people are buying real estate today, which makes no sense. I'll go into it at another point. Some people, why are they buying it? They're buying it because they have nothing else to do with their money. This is what they know. And they have 30 years to wait. They're giving it to it's called generational purchasing. They're not even buying real estate for themselves or for the kids that are alive today. They're buying it for someone who's not even thought about yet. And when that person gets old enough, that person will take over the real estate. So key risks in general investing. Opportunity costs. This is on page 7. Lots of time may be spent before the right deal comes along. All the while, you may be foregoing another revenue source. That's what we were saying before. Some people keep the dry powder. They keep the money on the side because I know I'm only making 1%. But I'm not going to settle on a stupid investment now because I know if I wait, it'll come together and things will happen. I'll use the money at that point. Economic cost. The actual outlay of money before ever investing in a purchase can be costly. It is not uncommon to spend money on appraisals, legal fees, and others only to see the deal fall through in the final moments. This is another key thing if you're the buyer of real estate. If you're investing in real estate, you don't have these risks. But if you think about the buyer of real estate, you decide today you're going to stop buying real estate. What are you doing? You're going online, buildings for sale. You're calling up sales brokers. Who paid you for that hour? Nobody. You took an economic risk. You had a cost right now for that hour that you weren't getting paid. Okay, you did it at night. You have a day job, you did it at night. That's fine. Then you have to go look at the properties on Sunday. You drive around, gas and tolls. It's not that much money, but it is. It adds up. Then you go ahead and you find a deal you like. You hire an attorney. You start negotiating a contract. It doesn't go through. Okay, it's only $1,000. It's $1,000. What if it goes through? Go to contract. As you do your due diligence, your detective work, you find the deal doesn't work anymore. You spend money on that process. You spend a lot of hours and time. And even if you want to say it didn't cost you money for that time you spent, but it's a cost, what else could you have done in that time? So these are risks that get involved also when you're buying real estate. So you have some people even go further down the line. They buy a piece of real estate. This is what happened since Trump won the presidency. The day he won, and the market believed that he's going to do a great job, the stock market went up. Rates went up. Rates went up in a positive light. Positive light means the market's coming back, inflation's coming back, things are happening, there's a buzz. So therefore, I don't focus on real estate. It was bad for real estate. The reason why it was bad for real estate, it's bad for two reasons. Number one is interest rates went up. The interest rates going up. Think about someone who went to contract to buy a building in the middle of October. Rates have been flat for a long time. People are saying rates may drop depending on who wins the presidency. No one's thinking then the Treasury bill is going to go up. And yes, how much was it going to go up? So it comes time to go to hard in the contract. The seller says, I'm not letting you stay open here. If you want to continue this dating process before you close, I want you to put money into the bank and lock it. If you don't end up closing, I get it. So at least I know there's a breakage. If you see all these big deals in the paper, AT&T buying this company and there's a breakage of $100 million, that's the deal. No company wants to tie up the resources and focus on a sale. You don't end up going through and then they have nothing to show. And even worse, some of the trade secrets are now out on the street. They go hard on the contract. What happens? This guy goes hard on his contract. It means he has $1 million, go from dry to hard, you can't touch it. And now you buying this building, assuming you're getting a 12% return on your money. You come to lock the interest rate and finalize your terms on the bank, and the bank, I'm sorry, since we started now, rates are up 0.75 of a point. Instead of paying 3% interest, you're paying 3.75% interest. On a $10 million deal, at 1% of a $10 million deal is $100,000. 0.75% is $75,000. Your payments a year are $75,000 more. That made a big effect. That took that 12% return potentially down to 8%. The only investor said, I'm walking away. I'm investing with you because you promised me a 12%, not an 8% return. And that's what happened during that time from November for the next 2 months. Just running around. And the question is who needed who more and who decided to go in anyway and make those deals happen. But that was that cost. Some people had to walk away from the contract. They couldn't raise the money. The deal didn't make sense anymore to buy. It made sense before that. Who takes that risk? The buyer of real estate. Not the investor. The investor's money only comes out the day you close. So the investor is giving up a lot to the syndicator or the buyer if they're investing with them. These are risks as you're buying real estate. You have to realize you're going into. There's one part over here in real estate that can be bad, really bad. It's called going backwards. If you sign recourse is another word for a personal guarantee. Now, by the way, with this course, you should have gotten a book called The Eastern Way. The Eastern Way, if you didn't get it, they'll email it out afterward. But The Eastern Way, I wrote a book, like a real estate concept, and I know it's trademarked, so I can't be real estate for dummies, but the concept, again. And then in the back is definitions. All the words are here. It's explained in simple English. But if you sign a recourse, personal guarantee on a loan, or you violated the bad boy carve-outs. So here's how it works when you do a loan. The bank makes a loan today. They should really want you to be personally liable for the loan. If something goes sour, I don't care about your building. I lent you $1 million. If it goes sour, I'm coming after you personally. That's how your house works. You sign on the house, and you bought a house for $300,000. So you got a loan for $300,000. The real estate, you get in trouble, God forbid, with your job, you can't afford the payments. Something happens. They foreclose on the house, and they sell it, and they only get $280,000. That $20,000 loss, they come after you for the money. You can't say, I gave you my house. What do you want from me? It's a personal guarantee. They come after you. That's why they take deposits. That's why they make you put down money. So hopefully, even if there's a correction, they're not going to lose money. But if you go ahead and you own a building, most banks will want you to sign a personal guarantee. For apartment buildings, since there's so much competition, so banks walked away from the need to sign personal guarantees. You borrow money in a shopping center, industrial building, office building. Almost all of them come with guarantees. That's why some people find lenders, and we'll get into it later on, that are willing to take a bigger risk and not charge you a guarantee and not make you sign a personal guarantee, but they're going to charge you a little bit higher of a rate. It's like insurance policy. You had to pay 3% and be on the hook if something goes wrong. Or would you rather pay 3.25% and not be on the hook? Everyone has different philosophies on that. But even if you don't sign a personal guarantee, what everybody signs is what they call a bad boy carve-out, a bad boy clause, which means you're basically telling the bank, I'm going to behave. I'm not going to steal any of the money that comes in from rents. I'm going to do what I'm supposed to do. If honestly the building goes sour because the market changes, I thought I'm getting $3,000 a month rent, I'm only getting $2,500, then everything is fine. If they could show that the owner collected $3,000 in rents, mismanaged the money somewhere, or took the money, whatever you want to call it, they did fraud, that's a bad one. You didn't behave. So the bank's saying, listen, I'll lend you money trusting the building. But if at the end of the day there's a problem with this building, and it's not just the building, it's not just the building is, I'll take the loss. But if there's a problem with the building because you did fraud or you didn't follow what you're supposed to do, then you automatically become liable. It's like a springing guarantee. You don't have a guarantee now, but it could spring out to become a guarantee. So you have to realize that in most investments, let's go back to the beginning of this discussion. You put $100 into the bank. The biggest risk you have is that you lose that $100. When you invest in real estate, because most people to invest in real estate take a loan out, it's possible that you put $100 into a deal, if you sign personal, the deal goes sour. Not only did you lose $100, but the bank took a loss of $62. You have to write a check from somewhere else for $62. So you can go backwards. That's what many people, the most important thing to them is not just retaining this investment, is making sure that their assets are protected. If something goes sour with this investment, it won't spread to everything else. That's why there's a thing called an SPV, single purpose vehicle, or SPE, single purpose entity. Most sophisticated lenders don't make you sign personal guarantees, say no problem. You don't sign a personal guarantee. But you're not owning this building in an entity that owns anything else. You have to open up a brand new LLC that buys this building. That's why anyone's involved in real estate at all, and knows family real estate, if it's anything, every piece of real estate is owned by a different LLC, not just because that's how the partnership works. Because this way, if God forbid something happens, this building can go out. Take the example of Microsoft. If Microsoft tomorrow has a big problem, they're not going after the founder of Microsoft personally for any money. They borrow money, it goes sour. Who signed on the loan? Microsoft, not the owner of Microsoft. It's LLC. Same thing with the building. There's a human being that's a warm body. There's a human being that signed a bad boy clause. If he did fraud, it pierces the corporate veil, it pierces this LLC, and the owner becomes liable. If the owner did what he's supposed to do, just people stop buying phones, people stop buying computers, and the company runs into problems, that's the risk of the bondholders. They lend money, and they're taking that risk that they're lending. So, but if you buy a piece of real estate, how do you best protect yourself on that piece of real estate? You don't forget about the lender side, but both sides. You buy this building as an LLC. The only thing this LLC owns is this building. So that's why most LLCs in real estate, let's say this building address here is 481. If I was buying this, I'd own 481 LLC. I have another building 493. I have the building 481 Oakland Road LLC. And that's how you'll set it up. And who owns it? It could be me. I could own 100 different LLCs. But if there's ever a problem with one, the other way around, it works the other way around. If I lend money, if I'm in trouble as a human being, then the people that I'm in trouble to have the right to go after my LLCs. But it doesn't work the other way around. So therefore, sometimes the bank wants it the other way. Sometimes the bank wants to insure it. Why? Because the bank says, I'm willing to trust you that this building won't have a problem. But I don't want you to own this building together with your business. Because maybe you'll have a problem with your business. Then it's interconnected and it comes into a problem. Interesting thing. Most people don't read fine print. Neither do I. But I try to find out what the fine print says. So I found the person who's ready to read all those 400 pages and they tell you the answers. And that's why I'll pay money for it instead of doing it myself. But in many bank accounts you have, in that fine print, when you open up a stupid little bank account, they have the right with fraud to go to take money and block money of any one of your accounts. So there are plenty of people who bank in one bank and they have their business in a different bank. So in case there's a problem with their business, that bank can't claw all their accounts and freeze them. two separate financial institutions. And sometimes they could, and that's why sometimes demand deposits in, and there's liens and all different types of things. But all these details, that's what people like great attorneys, depending on the level of risk deals you're doing. I believe as follows. I go to sleep every night. I do no fraud. I do nothing that I have to worry about the feds are knocking on my door. The feds are knocking on my door because they're looking for somebody, not because they're looking for me. They might want to. There's nothing off. So someone told me you're getting audited, I don't get nervous about it. Life is too short for those differences. What you want to understand about those who live in a cash business, don't pay taxes, it doesn't make sense, is because what could you do with the money? Now you begin to understand investments. If you could find good investments, it's worth it. Forget about. I'm not advocating for the U.S. government. I just want to explain to you the concept on the taxes. If you make $100 and you pay 40% taxes, so you're left with 60. But if you could take that 60 and make 15% a year on your money, that 60, it's $9 a year. It goes to 60, 69, 78, so on and so forth. Actually, it accrues with it, compounding, and it moves up. After a certain number of years, you're back to your 100, you're growing again. If you took cash, people that have cash, what are they doing with it? They sit there with nothing to do with it. It's getting tougher and tougher. So inflation kicks in. Yeah, very good. They got $100. Oh, it's all happening to pay tax. So if you really analyze all that money, it's like the lottery winners. They go broke after. If they analyze that cash over time, every year, the inflation is 2-3%. So over time, it's the opposite. It dips below to 60. On the flip side of the coin, over time, that 60, that money that they're putting in, they really end up spending more. Because it's the same with cash in anyway. They can't do anything. Oh, so you're supposed to buy a couch now, and the choice is spend $800 or $1,200. It's $400 here, $300 here. They buy this car before they know they spend it. So just in general, people that are could make real money. That's why everything becomes reportable. You could do a lot more stuff with it. Use it as leverage. You go to a bank, you have to show money down. You could leverage that money to get yourself those types of returns that you're looking for. The three common investments when you meet people and you talk to them is the stock market, started by a business, or real estate. On page 9, the stock market. The biggest pro to investing in a stock is that the stocks are liquid. Pretty much 99% of the time, if you want to sell the stock, you could sell it and get your cash. The way the financial markets work, barring the meltdown, but again, people say, what if? There's a million what if scenarios. But what do you plan for? You have to plan for a normal occurrence that could possibly happen. In the normal sense of the word, there's not going to be a total market meltdown. And if there is a total market meltdown, it's affecting a lot of other things anyway. So in the normal case, the pro is the stocks are liquid. Invest in a stock, I could go out and get my money back at any time. The other plus is that the stock itself goes up. So I invest in a stock, I buy a stock at $100, the company's doing well, the company stock becomes valued more. My stock now, if I sell it, I'm not just getting 100, getting 110, 120, 200, 400, depending on the stock. The risk reward was there, you get a crazy return. The con is you don't control the business operations of the company you bought the stock in. You have zero say. Some people like that fact. Passive. Totally passive. You have nothing to do with that at all. Put your money in. They don't want your opinion. They don't care for your opinion. Yeah. If your name is Warren Buffett, you're buying a certain percent of that person's stock. Then you got a seat at the board, a seat at the table. You can have it. But for the 99.9%, it's not even that just the 1% get that. Less than the 1% of the 1% have that say. That's where you're at. You have no say. Your investments are subject to the volatile conditions in the market, which means you could sell today. But what happens if right now people are nervous about the tech sector? You have your money in tech stocks. It's artificially lower. You're in trouble if you try to sell today. That's where the problem comes in. It's an you can't just decide I'm going to sell it when I want to sell it. And you could sell it any time, but you can't predict if that day is the bad day, for lack of a better term, to go ahead and sell it. Start or buy a business. Entrepreneurship, risks and rewards. So a new business requires almost all invested capital to be at risk. And takes a while until you see a stable positive cash flow. That's the biggest risk. You want to start a business, it costs $100,000 to start a business. That $100,000 is totally at risk. You're either not making a nickel will you make your money? You can't like tell people, oh, we'll make 10% of that money. It's all or none. It's totally risky. A lot of things come in. You have to take other partners down the line because you thought it cost 100, you need another 100, and you grow. You have to be a part of your business. So that's and all your money that you're investing is all at risk. On the flip side of the coin, there are people who might go out there and buy an existing business. This is the same example that story I gave before about buying that house. You buy a raw piece of land your next to neighbor only if the house is built perfect condition and make less because as is you could sell it to somebody else. An existing business may be less risky, but usually needs more money to acquire. So that pizza shop example, that's throwing off $100,000 a year, $200,000 a year. It's going to throw up $200,000 a year. But because it's not a startup, it might cost you 5 times the profits. He might sell that business to you for $1 million. So it costs more, but it's safer more. It's like I tell people in the office here, I don't mind making larger investments, but I don't want to I want to be cheap on expenses. So if someone comes to me tomorrow morning and says that, a certain item, we could go buy a certain item, and that item is an expense, and I want the cheapest possible way to buy that item. But if someone says this item is going to help your brand, if you do it right, people take it and they work with it, then I'm going to buy the right one. So I get some we gave out a couple of years ago those battery pack chargers, and so we got proposals to buy them anywhere from like $12 then to $30. But at the end of the day, we're debating back. So obviously the final choice is never the 12 and the 30. So it's like, okay, there's one for 27 and 30. It's like you narrow it down to your 2 closest choices. At the end of the day, we went with the $30 item because, just watching where the technology is going. Then, this was several years ago, we were able to charge up 2 laptops fully on that one battery pack. So he said, someone's not going to throw this out. Someone's going to keep it. It's a strong battery pack. It's like a little flimsy one that goes. So I'd rather spend 30 that's going to last, people can use, than 12 or $15. They can look, it looks nice the first day they get it, they put it in the drawer, they don't use it. This one they use. I meet people, I go to meetings, people are sitting there. I had clients call, you don't give it to my partner, what happened to me? So I knew it made a difference. Every one of those calls, I knew possibly converted to another deal at one point. So I'd rather buy that business. So would you rather buy a pizza shop that's existing for many years at $1 million and it's giving you a $200,000 return? So you have the return. And then you could say to yourself, oh, this pizza shop, the guy never did deliveries after 9 o'clock. I think if I did it, I could pick it up. He never did A, B, C, D, and E. He wasn't online. He didn't set up the Uber Eats today. I'll do that. So not only my money is safe, I know my fixed return, but I think I could better that return. I could bring it from $200,000 to $220,000. So my same $1 million investment is not throwing off $200,000 a year for me. It's throwing off 22%, $220,000. The biggest risk, though, for your own business is the exit is slow. If you want to sell that business, how many buyers are there? How big is the market? There's a lot more questions from a layman. Why you're selling, getting nervous. Think about this real estate course. You have to make a stupid decision if you take a course or not. And you could always, in theory, someone could drop out of something. And if you're not making the cool part of it, so you take the course, you don't take the course. You benefit, don't benefit. You're buying a business. And you trust him. Maybe some of the things I'm telling you. He's telling you everything is really fine. Really, it's like the store in Chicago. There's another pizza shop. He knows that there's a big pizza shop opening down the block. Something he knows about you don't know. Exit is very slow. In real estate, risk and reward. Page 11. With due diligence, you more confidently choose an investment that will maintain its cash flow and is therefore more protected from risk. You become that detective. Another word for due diligence is be a detective. Ask questions, check numbers, verify. Trust and verify is saying the army. I trust you, but I want to verify. And that's how you're going through. That's your due diligence. It's a very important point. It's also big for commercial real estate. If you buy a publicly traded company, the benefit you have in a publicly traded company is that they have what's called audited financial statements. That means from the top accounting firms went through all the books, and they verified and they confirmed everything. And they made sure that every expense is allocated the proper way. So for example, let's understand simple accounting. If I go out and I buy a computer for my office, the computer costs $1,000. Legally, you have to amortize it. You have to say the life of a computer. I didn't just spend $100,000. Like I bought everyone here a cup of water, a bottle of water, and I paid $0.25 for that water. That's it. The quarter's gone. When it comes to a computer, what's the life of a computer? Let's say the life of a computer is 5 years. So that means I spent my expenses here was $200, and over the next 4 years, I could take off every year another $200. So I in effect lent. I don't have the $1,000. Cash flow wise, I spent $1,000 out of my bank. But as far as the government is concerned, I didn't spend $1,000 because at the end of the year one, I have a computer worth $800, and I only lost $200. Year two, so on and so forth. Somebody who wants to show, and the people say they play with their tax returns. Okay, the concept of the play is that they could go and say, you know something? No, I got from my account and tell them that the lifespan of a computer is only 3 years, so I won't expense $333. Other people say, what are you talking about? Computers last maybe a year. I'm expensing it for $1,000. So now, if you were buying my business room, okay, go back to the pizza store again, the cash register. He bought cash registers. He spent $50,000 on cash registers. How did he expense that cash register? If he while he's looking to sell the business, he's going to get an account and he's going to say, cash registers list for 20 years. So you could write an expenses here of $2,000. So he shows he has $200,000 profit. He'll sell the building at 5 times $200,000. But if you really did an audit of it, you found that he bought a cash register this year, and that means a cash register you probably have to buy it only every 5 years. Then he really has another $8,000 he didn't write off, and the profit this year is only $192,000. So I'm going to be willing to buy it for 5 times profit, but not 5 times 200, it's 5 times 192. The only businesses that have audited financial statements are publicly traded companies. The beauty of real estate is that there's so much data that's out there, almost like an audited business, that if you're buying your little stupid building, your first building, you're buying a 6-unit apartment building somewhere, you could go online, you could pay for reports, or if you know a good broker, that the expert that knows the numbers in that area, they could tell you every single line item, what it should look like. So you could walk over to someone, with my top brokers in the office here, they're really what's called trusted advisors. They're able to go and look at the deal, and that's when I'm hiring a lot of those that run deals, brokers that run deals. On one end of it, I need people that are amazing at bringing business, trustworthy, honest, bringing business that can give general advice, steer the person right, and bring them to the right person. And the other part, I want experts that are the greatest at the numbers. I don't care what their personality is, per se. I don't care how the person looks. I don't care about anything about the fact that they're honest and know the numbers. So therefore, when a client could call up the office and say, I'm thinking about buying an 8-unit building, my first building, I could have someone sit here and tell them, before you tell me what your numbers are, let me tell you what it should look like. You should be collecting average rent of this for a 1-bedroom, this for a 2-bedroom, this for a 3-bedroom. The vacancy factor should be this. This expense line item should be within this range. This per unit, this per building. And now you could compare it. The guy told me he's throwing off $82,000 in this building. If I use your numbers, it's only going to throw off $62,000. You have the luxury of going into it. You try to buy a pizza shop, some town, some business. What are your comps? What are your comparables? What can you compare it for? That's the other beauty. You have a lot of people in real estate that could tell you what it should work for and how it should work. In real estate, the property values typically appreciates, and this is again primarily because of inflation. Inflation causes, one of the inflation causes are that expenses go up. One of the expenses are housing and rent. So rents are going to move up. Inflation, everything is going to keep moving up over time. The question is, it'd be a wrong dip in the market, but over time, over 30, 40, 50 years, real estate's always going to rise. It could be up here in a crash. It's going to come back up. So people say, why would I sell it during a crash? I'll keep it. So some people actually keep it. But people that are financial savvy say, you know something? You know I'm going to sell it now? Because this building I could sell, take a loss now, but I'll have cash in my hand. And I'll use that cash to buy other new deals that I get a higher return going forward. You're right. It's here. It's down here. It's going to come back here. But after 20 years, I could find another deal that I could buy now and get up to this point at a faster rate. So that's the emotional part that goes up and back as things go around. So property value typically appreciates. Like I said before, there's low barrier to entry. Money is green. When I'm selling a building, all I care about is that you're going to close the deal. So if I have an offer to sell a building for $1.1 million from someone I know will close, and you walk in to offer me $1.2 million, and I'm not sure if you're going to close, I'm going to sell it for the person $1.1 million. So when someone's a novice, a lot of times there's family fights, if it's real estate in the family. And then after someone dies, they want to sell the building. And there's a whole fight. You sold it for $1.1 million. I know someone who doesn't pay $1.2 million. It's not just about money. It's about certainty of execution. Will that person actually close? That becomes the debate ultimately. That's the relationship. I know you'll close. That's why some sellers, I don't think it makes sense to do an off-market deal, but some sellers sell a building off-market. Because I don't want to get onto the market. I know you shake my hand, you're going to sell at this price, I know I'm closing. And that's how buildings trade. But for you to go in, as long as you could show someone you have the money, There's nothing else you have. You don't need degree. You don't need anything else. Buy the building and you're in. You just have to come to the table with the money. The tax benefits. There are a lot of tax benefits. There's depreciation expense, which allows you to say, using that example of a computer. Aside from a computer, now, a key thing is very important to you. The government is always going to get their taxes. The question is when. The government is very patient. As I said, when the government is going after someone for fraud, the person has a lot to worry about. The government has unlimited money and unlimited time. They don't care if it takes them 12 years to prosecute. They'll do their time. You're sweating for 12 years. In real estate, it's depreciation. Depreciation, which to a certain extent makes no sense. You could say it does, but this is how it works. From a layman, it makes no sense. I buy a building to keep the numbers round for $30 million. The government says the lifespan of a building is 30 years. So that means I bought the building for $30 million. Every year, I lost $1 million of value because the building really is not worth that $30 million next year. It's only worth 29. Because in 30 years, I'll have to rebuild the building again. The reason why it's crazy is because real estate today sells based on cash flow and all that, but just understand the concept. So I have a building, 29 million. Next year, 28, 27, 26. So what happens as follows. In the normal course of the world, I buy something for 30 million. I sell it for 40. How much taxes do I pay? On $10 million. But when it comes to real estate, if I depreciate, at the end of the year one, I come to my tax returns. I made $1 million in profits the first year based on that $30 million building. Let's say that was the number. I should have to pay tax on $1 million. But the government says, no, you have depreciation. You lost 1/30th. There's different years. It's actually 27 years. It's different depending on the type of property. Let's keep it around the 30 years. The government says the taxing. You're able to write a tax. I said, no. But it depreciated 1/30th. So I have $1 million phantom loss on paper. That's why people have real estate don't pay taxes. This year, how much is the tax bill? 0. I made $1 million, but I lost $1 million. Now, you could laugh and say it's a little bit crazy. However, I sell my building next year for $30 million. I broke even officially. No, they catch up then. My cost of my building, my cost basis is no longer 30 million. My cost basis is 29. So you may help out in the beginning for cash flow wise, but over time you're going to pay. You're going to catch up. After 30 years, I sell my building for $10 million. I have to pay tax on the 10 million. I can't say, whoa, I bought it for 30, I'm selling for 10, I lost. No, there's the cost basis. I depreciated the money over time, and because of that depreciation over time, I have to pay the catch up. So someone in real estate, while they're growing their portfolio, they're paying very little taxes because they keep offsetting it. And that's why they buy the real estate. So if someone actually has a business, depending on what level of real estate, sometimes my income in my business could offset. So someone works and they make $1 million a year, they're paying the highest tax rate. They can figure out how that million could offset off depreciation of real estate. That's why people buy real estate just for the tax play. They don't mind overpaying for the building. It doesn't mean anything to them. They'd rather the benefit of deferring their tax bill for 30 years has a value also. If I make $1 million and I don't have to pay 40% in taxes this year or 50%, I have $500,000 extra to invest. What is that worth to me over the next 30 years? It's worth to overpay for the building. And I only have the problem when I sell. That's how these situations go. So there's depreciation. 1031 exchange, and that's the biggest risk to real estate today. Talking with Trump and President, because he understands that this thing, to a large extent, makes no sense today. 1031 exchange is the same exact concept. I sell a building for 30 million. I bought it for 10. Let's say no depreciation. In normal sense, my cost basis is 10 million. I'm going to go ahead and sell it. I'm going to go ahead and sell this for 30 million. 10, I made 20 million profit. I should really, like any stock, I should pay taxes on the 20 million. At the end of the 20 million, and I have now an extra, let's say I pay 10 million taxes. I have 20 million to do my next deal. 1031 exchange comes along and says, you know something? No, if you use the full 30, there's a lot of details to it. If you use the full 30 to buy another building, you could keep deferring that tax bill. So now I buy the next building for 30 million. I don't pay taxes again. It keeps rolling. It's 1031. That's why I meet people at a 1031 exchange. If I don't find something to buy, I have to pay taxes now. I'll pay 31 for that building. It's worth it. That's what happens in a rising market. If they change the law, the 1031 exchange doesn't happen anymore like stocks. No 1031 exchange of stocks. You buy a stock, you sell it, you pay taxes. A big part of the game is going to be over. People almost no one will sell the buildings anymore. They'll keep it for sure, because they can't trade up. Now, as crazy as the law sounds, like everything else is a loophole. Where did the law come into existence? It made a lot of sense when it came into existence. You have a farm. The family has a farm. farm is worth $500,000. The family's growing. They can't live off a farm, a $500,000 farm. They need $1 million farm. They saved up money, or they got a bank loan. If they sold this for $500,000, they have enough money, another $100,000, $200,000 own money plus $300,000 from a bank. They can buy that next thing for $1 million. But if they sell this for $500,000, they have to pay tax on it. They only have $300,000 left. They're short another $200,000. How are they going to buy that next farm? So the government said, 1031 exchange. If you buy a similar type of asset with this money to the next thing, then it works fine. It wasn't meant for the real estate wheeling and dealing that happens today. But 1031 exchange works, so people use it. Cost segregation is, if you thought any of this made sense or no sense, cost segregation is the next level of this. The government, you can understand that the physical structure depreciates over time. The building has to be maintained. It's not worth the same over time. Okay? Cost segregation comes as you bought this building for $1 million, for $30 million. Over 30 years, it gets divided. $1 million a year. Let me go a little bit different. But in this building that you bought, imagine someone bought a hospital. Inside the hospital, sometimes there's equipment attached to the wall. There's fixtures. There's a bunch of things there. A hotel. They say this fixture, you have out of the 30 million, 20 million, $2 million really fixtures. Those fixtures only have a lifespan of 3 years. So on $2 million of the money, we're going to amortize it over 3 years. $4 million is carpets. How much is the actual worth of all the carpets that are in the building right now? Right now, the carpet's worth $850,000. That's only has about 5 years left of the carpet. It's going to put 5 years. And they come back and say the blended average is not 30 years. Divide over 30 years. You can divide over 21 years, or 17 years, or 13 years. So at the end of the day, is the government getting the money when he eventually sells the building down the line? Yes. But until that point, he could write off every year almost $2 million a year to offset off his income on the other side of the equation. Although there's generally a market in which to sell your property and many people with whom to invest, you can't just snap your fingers and sell. That's the key thing. To the contrary, if you try to snap your fingers and sell, you'd be like your neighbor next door. It's worth $500. You want to sell by Monday? I'll offer you $450. Are you desperate? $425. You're really desperate? $400. And you keep lowering the price. How many people are ready to buy and move fast? That's what people say. I'm going to take it out to the market. If I get the right price, I'll sell. The greatest people that I know from living this business, I know clients who are in deep trouble. They had to sell. They had the greatest poker face. Okay, so walk away. I'll go to the next guy. I knew they had to take this contract. But they felt to give up weakness. The buyer smells blood, and that's it. They're dead. The last point is a key point. Real estate is illiquid investment. So you have liquid, my money's sitting there, it's liquid. Anytime I want it, I could sell. I draw powder in the bank, do what I want. This is the opposite. Not only can you just sell at the snap of a finger, you're always putting money into the building. You're always reinvesting. A tenant leaves, if I put $20,000 into the unit, instead of getting $1,800 rent, I get $2,400 rent. So on that investment, if I invest now $20,000 in the building, I collect $400 more a month in rent. It's $5,000 a year. It's amazing. I'll make another 25% on my money. You're always putting back your money. So you're not even seeing your returns as you go. We're going to stop here today. We'll just close it.